You've probably heard this number floating around. It's huge, almost impossible to wrap your head around. But it affects every single one of us. I'm talking about the U.S. national debt. And today, we're going to dig into what this new record-breaking number actually means for you.
And there it is, $37 trillion for the very first time the U.S. national debt has crossed that line. I mean, that's a 37 with 12 zeros after it. It's a truly staggering figure, and honestly, it's a pretty troubling milestone for the American economy.
Okay, so what does a number that big really mean in the real world? Well, you can think of it like a ripple effect, right? It starts small and then spreads out. So that's what we're going to do. We'll follow those ripples starting with something super personal, your wallet. Then we'll zoom out to the entire U.S. economy. And finally, we'll look at what this all means for our future.
All right, let's dive right into that first ripple, the one that's closest to home. How this national debt actually ends up squeezing your wallet. So how does this whole thing work? It's kind of a chain reaction. First, the government has to borrow just massive amounts of money to cover all its spending. When it borrows that much, it creates a huge demand for money, and that pushes interest rates up for literally everyone. So what does that mean for you? Well, it means those big loans, your mortgage, your car loan, they get more expensive. Even your credit card debt costs more. And it's not just you. Businesses also have to pay more to borrow, which makes it harder for them to expand and hire new people. And that slows down how fast our paychecks grow. And look, this isn't just a quick, short-term pinch we're talking about. The analysis is pretty clear here. This drag on business investment, it ends up slowing down productivity across the board. The bottom line? It has a direct, long-term hit on wages and the standard of living for generations to come.
Okay, so we've seen how it hits us personally. Now let's zoom out and look at that second ripple. The way this debt acts like a drag on the entire U.S. economy.
What you're seeing here is a huge trade-off playing out in the federal budget. See that slice for interest on debt? That piece of the pie is growing, and it's growing fast. In fact, it's one of the fastest growing expenses we have. And you have to remember, that's your taxpayer money. It's money that isn't going to things like fixing roads, funding schools, or investing in new research. Nope, it's just paying the interest on money we've already borrowed.
And the scale of those interest payments is just wow. The Congressional Budget Office estimates that over the next 10 years, just paying the interest, not even the debt itself, just the interest, is going to cost us almost $14 trillion. Think about that. That's a monumental amount of money that could be invested back into the country, into our future.
This all leads to a really key economic idea called the crowding out effect. We kind of touched on it a minute ago, but here's the simple version. When the government is borrowing so much money, it's basically competing with private companies for that same pool of cash. This competition drives up the cost of borrowing for everyone. So for a private business, it suddenly becomes way more expensive to get a loan to, build a new factory, invest in new tech, or hire more people. The government's borrowing effectively crowds them out of the market.
And this isn't just some abstract theory, The impact is real and it's measurable. Projections show that if we stay on this path, the debt could shrink our economy, our GDP, by about $340 billion by 2035. That's a huge hit. And what comes with that? Well, it could mean about 1.2 million fewer jobs. That's a very real, very tangible drag on our country's prosperity. All right, that brings us to the third and final ripple. And this one is the widest of all. We're talking about the long-term risks this creates for our future, not just here at home, but around the world. If we let this debt spiral continue unchecked, the risks start to get pretty severe. We're talking about things like a potential downgrade to the U.S. credit rating, a loss of confidence from investors, maybe even a full-blown fiscal crisis. And because the U.S. dollar is the world's go-to currency, our problems can easily cause shaky markets all over the globe. But it's that last point on the list that might just be the most important one, having less flexibility when a real emergency strikes.
And this is really the crucial takeaway. Having such a high national debt seriously limits what's called our fiscal flexibility. Just think about it for a second. When the next big crisis hits, and we know something always does, right? Whether it's another pandemic, a major recession, a war, whatever it is, the government's ability to step in, to borrow and spend, to protect people and the economy, it's just not what it used to be. Our toolbox for dealing with emergencies gets a whole lot smaller. So this all leaves us with a really fundamental question to think about. That $37 trillion number,
It isn't just some record of past spending. It's really a measure of our readiness for the future. With our ability to respond to a crisis shrinking, you have to ask, just how prepared are we for the next one?